Hello, everyone, and welcome to today's episode of Real Estate Tuesdays. We meet here every Tuesday at 2 p.m. Arizona time to chat about a different real estate related topic. Sometimes we invite other professionals related to our marketplace to just help gain some insight and give you information as a consumer. Well, we know tax season is here, it's upon us, and we also know that our real estate home prices have been high and prices have been increasing. Supply is low, demand is high. So you may be thinking to yourself, well, maybe now is a great time to sell either your primary residence or your investment property. Maybe now is a great time to reap the profits of my investment. But what we also know with great profits can mean huge taxes. So today we're going to discuss a few known tactics to potentially reduce or avoid your capital gains tax for this point in time. Now, it is important to know that I am a real estate professional, a realtor in Arizona, right? These types of videos are here to kind of get the mind thinking about things that may be particular to you. Every one situation is different. So it is important for you to take this information and whatever questions you have and discuss it with your CPA, your financial advisor, your tax professional, right? If you have a question regarding real estate, come this way. And if you need recommendations, I'm more than happy to provide that as well. Now, on to today's topic. I'll put this here for you as well, just to give you an idea of where we are with home prices today. So that'll give you an idea of where we are, and I'm sure it's greatly different than where we were 5, 10 plus years ago. So realize that the profits you make from selling a real estate investment may look great at first glance. But if you consider the GCT, the federal capital gains tax you have to pay, which can be as high as 37%, there may not be a whole lot left after you see that, or you may not be as excited after you see what that amount is. So today we'll chat a little bit about that. So first and foremost, what is capital gains? Okay. Capital gains tax is the fee you pay on the profits made from selling an asset. Today's conversation is about real estate. So talk about that. Capital gains taxes can apply to securities such as stocks and bonds and tangible assets like real estate, cars, and boats. Now, the IRS and many states assess capital gains taxes on the difference between what you pay for an asset, also known as your cost basis, and what you sell it for, your final sales price. So here's an example. How do capital gains work on real estate? Well, it depends. Don't you love that answer? It depends on your tax filing status. It depends on your home sales price, but you may be eligible for an exclusion. Let's take a look at that. So $250,000 of capital gains on real estate, if you're single, that's the amount of the exclusion, or $500,000 of capital gains on real estate if you are married or filing jointly. So a quick example, if you bought a home, say 10 years ago for $200,000 and sold it today for $800,000, right? Again, an example, but not so far-fetched in some cases. You made $600,000. If you're married filing jointly, $500,000 of that gain, of that $600,000 profit, might not be subject to capital gains, but $100,000 of the gains could be. Okay? When do you pay capital gains on a home sale? You pay tax on the whole gain of the home sale. if any of the factors are true. If the home was not your primary residence, if you own the property for less than 2 years in a 5-year period before you sold it, if you didn't live in the house for at least 2 years of that 5-year period before you sold it, if you already claimed that exclusion, that $250,000 exclusion if you're single, or $500,000 exclusion if you're married or filing jointly, if you already claim that on another home in a 2-year period, then you're not eligible for capital gains. If you bought the house through a like-kind exchange, like a 1031 exchange in the past 5 years, and if you are subject to expatriate tax. So if you're still not sure if you qualify, I suggest that you check out irs.gov and search for capital gains tax, and you will see this information provided for you in detail. Now, there are short-term capital gains and long-term capital gains. Let's think of it this way. Short-term capital gains rates apply to an asset owned less than a year. So say if you're flipping real estate, long-term capital gains taxes typically apply to an asset owned longer than a year. So if you had long-term rentals, for instance. So let's get down to the nitty-gritty. You know, some people feel like it is their civic duty in order to pay taxes and do it for the greater good. And then there are others of us that try to greatly reduce or avoid their taxes that they pay. So today we'll chat again about how to avoid capital gains tax on a home sale, right? One way, live in the house for at least 2 years. All right. 2 years doesn't need to be consecutive, but house flippers should be aware. Okay. Should be beware. If you sell a house that you didn't live in for at least 2 years, the gains, the profit from the sale of that property could be taxable. All right. Selling in less than a year is especially expensive because you could be subject to a short-term capital gains tax, which is generally higher than your long-term capital gains tax, right? Be sure to keep receipts for your home improvements, right? Very important. The cost basis of your home typically includes what you paid to purchase it, as well as the improvements you made over time, over the years. So when your cost basis is higher, your exposure to capital gains tax could be lower. Think about remodels, expansions, additions, new windows, landscaping, fencing, new driveways, air conditioning installs. All of these things, all of these types of improvements might cut your capital gains tax. Another way would be to sell your property when your income is low. Remember, your GCT, your capital gains tax, is determined by your tax bracket, which is calculated based on your income. If you can be a little strategic at the time of the sale, could have a positive impact on your tax burden. Again, chat with your CPA, your tax professional, a little bit about this, and if this is the best course of action for you. Now, here is another one not to be missed. Take advantage of a 1031 exchange. You say, wait a minute. What is a 1031 exchange? And we will do a deep dive into 1031 exchanges at a later episode. But for now, know that it is a way to avoid capital gains tax. Yes, I'm looking at my notes. All right. Also known as depreciation recapture tax, a tax-free exchange, a 1031 tax-free exchange. So a 1031 exchange allows you to trade one property for another like kind property without paying taxes, without paying capital gains tax. Let's be specific here. Now, of course, with everything, there are specific rules that you need to follow, right? So why is this helpful really to you? Because you, as an investor, get to use 100% of the profits from the sale to reinvest into the next property in order to avoid the gain. So this maximizes the growth and the compounding of your investments. All right. So again, when you sell a rental or an investment property, you can roll those proceeds into the sale of another similar type of property to avoid capital gains tax. And it's called a 1031 exchange, and it's popular among real estate investors as a strategy for building wealth. So know that the tax code is very complex, and there are criteria that you must meet. And matter of fact, working with what is known as a QI, a qualified intermediary with a 1031 exchange, is important to make sure that this exchange, that this process is followed to a T, and that you don't trigger any taxes to be due if done improperly. All right. Another way to reduce or defer your capital gains tax is to invest in opportunity zones funds. In 2017, our government, the US government, designated many distressed areas as opportunity zones. Arizona was one of the first areas to really work this program and designate these zones, get funding and investors and everything going in those zones, as we see a lot of projects going on around town are a result of that effort. This effort also drives investment in housing, small business, infrastructure, and in these various reasons. If you're wondering, take a look at what's happening in Metro Center. Take a look at what's happening, what used to be the Paradise Valley Mall, what used to be the Fiesta Mall in Mesa, all designated opportunity zones. When you invest in an opportunity zone with the capital gains from the sale of a property, you can take advantage of the following tax benefits. You can defer all capital gains for 8 years if the profits are reinvested and held in the opportunity zone. You can decrease the amount of any capital gains tax by 10 to 15% if the investment is held for 5 and 7 years. Or you can receive a full exemption from any capital gains tax on all future capital gains from the invested funds if the investment is held for at least 10 years. Right? Now think about how long you've held your current investment. And are you maximizing the return on that investment? Are you going to need to put money into that investment in order to continue realizing that rate of return? Is it smarter for you to take those funds in a hot residential sales environment like we are today and roll them into the next opportunity? So know that, remember when doing this, that is particularly with the 1031 exchange, that these things need to be rolled into something that is like kind. All right. Like kind, meaning investment property for investment property. So it has to be producing income. Right. So again, something to keep in mind. Let's see. Yeah. Well, that's what I got. If you have any questions regarding the Arizona real estate markets, or you're looking for any referrals to talk a little bit more about 1031 exchange or any other ways to defer or reduce your taxable, what's the word I'm looking for? just to reduce your tax, then I'm more than happy to provide those referrals for you. If you are curious what your property is worth in today's ultra hot real estate market, feel free to reach out to me as well. I thank you as always for tuning in, and I look forward to speaking with you. Ta-ta for now.